So, ladies and gentlemen, please welcome to the stage our own walking economist, Professor Matthew Lester.
Good afternoon. Thank you very much. This is my 25th year of doing the BDO budget seminar. That makes me feel older than topping up my retirement annuity. It's been an amazingly challenging year working for Judge Davis on the Davis Tax Committee. I've never known an academic who can challenge a person better. And I've never known a South African who is genuinely more interested in equity above all. And he doesn't tolerate fools. So it's a challenging thing working for him. But please, from this lecture, it's nothing that Davis said or the committee said. This is my interpretation, and you can blame me for that. And I've called the lecture, let's have another go at SONA 2015, because we didn't get a speech. And it runs something like this. We could pay for Nkandla in 2 hours using the tax base. Yet, this has become an issue now that has completely dominated the media. It's dominated Parliament. And it seems that we are going to go on and on with this being the crisp issue, when in fact we have a nation in crisis. And that is what is the biggest scandal in the whole thing. We're all trying to make political mood out of Nkandla. My career started thanks to this man, who sent me to the army, and I ducked to ZARS, and I worked firstly under Barr and du Plessis and Reserve Bank Governor Christels. And when one measures change and one looks back at it over 25 years, a kind firm called BDO said, make us some budget lectures, which normally were just about the cigarette price hike and that sort of thing. Took 3 weeks to get them together. Then along comes Mandela. And look at this for an image. His finances were run completely by white South Africans. And the amazing thing about that was, with all that brain power, they couldn't solve the problem. Because if you look at the growth rates up until 1998, it just wasn't working. So along we come in the Mbeki era, and we start changing things. We take SARS out of the civil service. We go with the team which goes Gordon at SARS, Tito Mboweni at the Reserve Bank, and South Africa's favourite couple, Ramos and Manuel at National Treasury. And those were our finest hours up until 2008. In fact, that was where the budget became more popular than a ticket to the JMB Met. Absolutely fantastic. But in spite of all the brilliance at SARS and National Treasury, what was driving that was the world economy. And it all came to an end at the end of the financial crisis. So now we move into the Zuma generation, Generation Z, or the silent generation. And we have to say, well, we can't have a Minister of Finance who's married to the head of ABSA, so we promote Gordon to Minister of Finance, replace Mbeki with Marcus, and then we ran with Magashula until it all came apart. And that looked like the team that had the answer. The big thing is they didn't. 2009, I think virtually every politician in the world read Reinhardt and Rogoff's Aftermath of the Financial Crisis, which said that GDP growth rates would recover in 2 years. This was the graph of 6 years ago. And so politicians said, well, no need to make people uncomfortable. We can borrow our way through this cycle, and we'll be back on the road again in 3 years. And here we are 6 years later. We forecast a growth rate of 2.5% for this year. It was down to 1.4% by the medium-term budget framework speech in October, and today they say they're going to do 2%. And if that is your biggest single driver of tax collections in the country, you've got a problem. But it wasn't Gordon or any one particular person who made the wrong call back in 2009. If one looks at this graph, for example, the World Bank, the IMF, National Treasury, and the South African Reserve Bank all said that growth rates would be above 3% by now, and we would be on the road again. And they've all been continually downgrading their estimates. Now, so everybody got it wrong. But the effect was that based on the policies of 2009, we said that by 2015 the national debt trajectory would have gone past its apex and would have reduced. That's the 2012 estimate. We tried again in 2013 and it still didn't work. And by October last year, the national debt trajectory had increased to the level that it was unsustainable. We were starting to look a bit like Greece. And at that point, you get the takeover of the new Minister of Finance, Nahan Evneni, and he says we have to stabilize the debt trajectory. So that's our position, and they said 30 billion required as at October last year. If one looks at the extent of change, what we've now done is we've said redeploy Gordon, replace him with Neni, that's a promotion. We've got a promotion in the Reserve Bank. The deputy becomes the governor. And we have an outside appointment in ZARS. And that is causing a huge amount of steam in the media at the moment, with people trying to blow up resignations. And they say, what's going on? Well, SARS is going on a process of internal self-assessment. And that's what's wrong with that. And I say nothing's wrong with that. We've had SARS since 1998, and nobody has ever questioned what they've done. And yet we, as the taxpayer, know that there are issues at SARS that we cannot resolve, and that the modernization program is going on too slowly. So I've got no problem with them having a look at themselves. Let's see what happens with that as time goes by. But back to Nena at the medium-term budgets framework speech. Here's the first salvo. The choice we are considering is a difficult one, and we can no longer postpone this course. Why? What's he saying with that? He's saying in the budget, sorry, we now don't reduce expenditure by 15 billion, we've got to go to 25. And we have to increase taxes by 17 billion, not 15 billion. Why? Well, at the MTBF, we were 10 billion down on budget for this year. That figure has been moved up to 14.7. Not good news. The balance of payments current account is in distress. The rand, very volatile and generally weakening. And we still have a tax policy to this day that is based on the thoughts of Ramos and Manuel. What's changed? Take your big taxes. You've got 3 big taxes in South Africa. Personal income tax, the biggest, always has been, followed by corporate and VAT. Those are your big 3. All the others make up the 4th tax. They don't even come close to it. What the big thing that we're looking at is that Ramos and Manuel said we can do it on 3 taxes. But if your corporate tax now starts to ail and really have a tough time because of the economic cycles that have followed on since 2011 and Marikana and everything else, we've got one cylinder missing. And the question is, how do you replace it? And the figures that come out today reflect this. Thank goodness for the individual taxpayer. You're going to come in, they estimate 15 billion ahead of budget this year and save the country for about the 8th time in the last 10 years. Corporate's going to lag behind, and even the upturn in retail that we experienced in December is -6, and then we have others down. For example, we can't smoke enough, we can't put the electricity on, and all the rest of it. So we've got a whole lot of other little ones making up the 15 billion. Again, the pressure falling on the individual taxpayer. So we come up with a game plan today, which works as follows. We will stay with fiscal drag relief, because we've done that every day for 15 years, looking after the lower end of the tax table. Instead, what we're going to do is we're going to put 1% tax increase on the top tax brackets. That will make back what we've given away on the fiscal drag adjustment. We're going to give you a tiny medical increase to buy you half a Viagra tablet each per month. That will cost 920 million rand. We're going to give you double the energy efficiency savings allowance, but it's still too complicated for anybody to claim it. Transfer duty, we're going to give an adjustment there, but cleverly bring in a form of wealth taxation which nobody's going to recognize. Then we'll knock the hell out of the fuel levy, everybody predicted that, hammer the smokers and the booze, and we should make it. Well, that looks like pretty simple stuff, but what is the long-term implication? Let's go into them all and have a bigger debt. The debt level in this budget is stabilized. And that was the big challenge of this year's budget. The question now is, what haven't they done? So, there are your tax forecasts for the next year. Watch where the emphasis goes. Individual pay an extra 43 billion. Consumer pay 43 billion. But the third cylinder, corporate, is only expected to give the 15. And that's the big problem. We don't have the big fourth tax, which in most of the rest of the world is social security tax. And we haven't brought in carbon tax because Australia can't get it right. So when we go to companies, we say, right, 500 companies out of 1 million have taxable income of over 100 million, but they're in distress. We can't afford to fiddle with the corporate tax rates. So corporate flat tax rate of 28% stays the same. CGT inclusion rate stays the same. Dividend tax stays the same. We can't put it up because then the whole lot will collapse. Important to look at in this is we are now in February. The biggest tax checks in grey on your screen there are your second provisionals, which are now forced to be an estimate, and the big ones come in February and March. They don't know yet what those checks are going to be. And if you're Sasol, you're calculating down, big time, with the reduction in the resources prices. So only on the 1st of April will we be able to assess how close they can get to that 15 billion rand shortfall. Also terribly important in this is mining in light blue has now declined to 8% of total tax collections in South Africa. We're doing the IMF, we're doing a report with the IMF on mining in South Africa and the taxation of mining. And sometimes we wonder, well, shouldn't we just exempt mines? Because it's not the tax that's the issue with the mining. It's the foreign exchange earnings. 50% of South Africa's foreign exchange earnings still come from mining. And what happens the day the mines run out or we just don't mine anymore? Where is the foreign currency going to come from to run our country? Part of the issue with the corporates, and there is a glimmer of hope here, is that the level of assessed losses that were incurred after the financial crisis has started to drop off, and maybe that will help next year. That's about the only glimmer of hope that we can see. Interestingly as well, coming in this, is CGT. We've had this huge fuss about it now since 2001, where one looks at it in the early years and it wasn't worth having. If one looks at the 2014 tax collections from CGT, they started to ramp up, but notice it's not the individual that's paying it, it's the corporate, because they have a higher inclusion rate, they have bigger capital gains. And when one looks into the future, we get economists saying, why should there be any difference between a capital gain and a revenue gain in a company? Not even for accounting do we make any difference on this. And there is, in the long term, pressure on that upward CGT rate, but it didn't happen this afternoon. Because the focal point is BEPS, not BERPS. Base erosion and profit shifting. The first report of the Davis Tax Committee is out on this, and it reflects that between 2008 and 2011, nearly 50 billion rand left South Africa paying for non-good payments. And 29 billion of that was legal, accounting and management services. And you've got to say, it can't all be kosher. What is still going on in South Africa's third national sport after rugby and cricket? What's called FCOM, Ekvat Kontant Seemania. What are you doing with that? Is SARS inspecting it? Is it the big issue? And this is playing up in the media daily, not locally, but international. Last week, the Swiss attacked the head of HSBC. Well, they haven't even dealt with all the hot money from 1945, and now we're trying to get into somebody who's just trying to structure his package. What's happening? And this translates across into the UK, where Cameron particularly is going on and on about BEPS. What's the issue? Well, it's nice to have a whipping boy, right? Who can you blame for the lot of your economy? The state of international transfer pricing, and we can hit the big names like Starbucks and Google and all the rest of it. When you bring it home to South Africa, can BEPS save South Africa? Going and looking at transfer pricing and the 500 major corporates. Well, if you take those numbers and we say, well, 50 billion was schlepped in 3 years, let's say it was all grey. Well, that only comes down to 14 billion in total tax over 3 years when we're trying to collect 220 billion rand a year from companies. So the war on finance will come on transfer pricing and offshore structuring. And I'm sure that there's going to be some big developments in that. It creates an enormous risk for a company. And the BEPS lot are sitting in Paris and they're writing reports like crazy. They wrote 7 reports last year. And they're all very long. The Davis Tax Committee report is over 300 pages long. I finished 3 bottles of scotch before I got to page 100. But the bottom line on it is you've got to look at it in terms of tax governance. So King 3 is now 6 years old. He said create a chairman, then create a board of directors, and create risk committees. Audit committee, a risk committee, a remuneration committee. Now King says, watch out for the reputation of your company. And what's just happened in HSBC is their reputation is in tatters. And what I'm recommending is that it's time for a revision on King 3. We need to have the tax committee, where we put the nerds who know what's going on this, and they report separately to the chairman about what is going on in a company's tax system. And wouldn't it be nice, this is my recommendation, if sitting on that tax committee was the stakeholder themselves, ZARS, so that we don't have these things pitching up 5 years later and biting everybody in the bum and everybody else who did it's left the company already. And what we could do in a tax committee agenda is saying, number one, we've got this new Tax Administration Act with a whole new load of laws that nobody studied. That's from 2 years ago. Nobody knows what to do when a query comes from SARS, how to respond to it. Then we've got to go and have a look at base erosion and profit shifting, try and understand 15 reports and all the different things that go on with them. From the digital economy to having foreign companies, to transfer pricing and all the rest of it. And when we've done all that, we need to look at the threat of transaction taxes to our bottom line. Things like fuel levy, electricity levy, and all of that type of stuff. And I think that that should be a new committee. I am more worried about the management of tax than tax planning itself today. Moving away from that, we come to the SBC report of the DTC. This comes from the National Development Plan, first time we're going to mention that this afternoon, which says that we're going to pin our hopes for 2030 on SMEs. And what's incredible about it is there is no common definition of an SME in South Africa. It's all been sitting in the Department of Trade and Industry for years. So we broke it up into 3 sectors. We said there is the informal sector, which we are saying is survivalist business. The job of SARS is to leave them alone as far as possible. SME, where there is growth potential, is what Michael Spicer refers to as the missing middle. And then you can have your formal sector of 500 companies up the top. So we've got 3 levels, and they must be dealt with evenly. So we have the SBC tax rates, which have been around for 2012. We looked into them. It was absolutely incredible. Who gets the biggest benefit as a sector? Services companies, estate agents, medics, etc. They've all got SBCs. And they creep in there by using the 3-person rule, where if you have more than 3 employees who are not related to the owner, they get into the system. And that's now getting even further abused, where every consultant can go out and hire 3 matrics who are doing nothing, pay them 2,000 Rand a month, tax deductible, receive 1,000 Rand a month each back on ETI tax-free, and you've kicked yourself into be taxed at the preferential SBC rate. And we found that a quarter of South Africa's benefits that are supposed to be going to the SME sector are completely caught up being in clever ways in getting into the SBC formula. We have suggested a refundable compliance rebate, not because it's a perfect solution, but we would like to keep the 1.3 billion Rand that is currently made available to SMEs within the SME sector instead of throwing it back into the bucket with all the rest of South Africa's money. So that's the missing middle. That's all we could say at this stage. Well, if we're going to grow the SME sector, you're never going to design a tax package to grow an SME sector. We need other things like finances, we need spaces for people to trade, security, loans, and all the rest of it. When it comes to the informal sector, I'm rather proud of this one today because this was one of my recommendations, which is turnover tax. We have taken turnover tax and we have pushed it right up, the threshold levels. Up to R1 million a day. If you are a small trader, your tax liability is virtually nothing. What we're saying to you is go out there, trade, and support yourself and provide infrastructure for South Africa. But your mandatory registration level for VAT will stay at R1 million, and we just want to keep track of who you are, because at some stage we've got to say what's hiding in the informal sector, because I think that there's as much tax evasion in the informal sector as there is in BEPS in South Africa. Moving on to personal tax. So we have 2 categories of taxpayers. Watch this. A huge chunk, about 50% of the taxpayers actually paying, and then a tiny little bit at the top, 5% of taxpayers earning over 500,000 Rand a year, and between the 2 categories we split the bill. And what we've been doing is saying, from the manual era, look after the lower end taxpayer. In fact, you can extend that all the way to the middle income earner. And the tax benefits that have been going to the top end taxpayer have been reduced over the last couple of years. So in 2014, fiscal drag adjustment of 7 billion Rand, Prof Gordon, primarily aimed at the lower end taxpayer. Same thing 2015. Now what everybody was predicting in this year's budget was that if we just said fiscal drag adjustment 3 billion Rand, nobody would notice. Parliamentarians think fiscal drag is some sort of person dressed up in a cocktail dress. So they don't look at that. They very cleverly, when they looked at 2016, they said we're going to deal with this in 2 ways. We're going to give a full fiscal drag adjustment to the first 2 chunks of the tax rate. Then we're going to increase the tax rates on the next levels all the way up to 700,000. And that is going to raise an additional 9 billion. But by widening the brackets, we're going to give back 8 billion of it. So it looks like there's no tax increase. But effectively, you have got a very real increase of 43 billion Rand in personal tax budgeted for this year. And then we'll give you an extra 13 Rand a month on your medical credit, which, that's half the Viagra pill, which will soften the blow. Now look what it does. There are your numbers of taxpayers. So in total there are 15 million tax registrations at ZARS. However, only 7 million are actually anywhere near paid. So today, if you're under 70,000, goodbye, no tax. And then it starts escalating from there. Until you get to 1.5 billion, where there are only 78,000 South African taxpayers who earn that amount. We could fit them all in the stadium outside here this afternoon. And what they're doing is they're saying, leave the first 2 brackets alone, 0, 0. And then take 1 billion Rand from each bracket. And for those over 1.5 billion, like Cyril, if you can afford to pay 40 billion for a Buffalo Bull, bid that at least, you can pay 2. And that's for the 78,000. When one looks at the distribution of the burden at the end of it, we find 78,000 taxpayers earning over 1.5 million will pay 89 billion Rand in personal tax alone next year, okay, or 22.7% of the PIT burden just from 78,000 people. The problem we have in South Africa, we need to find some more wealthy taxpayers. They're as scarce as rhinos. So we now move that on and say, well, what about my personal financial plan? So we increase the interest-free allowances a little bit. That's just to confuse students who are writing the CA board exam. And then the big change comes with retirement reform. 1st of March, next week, was supposed to be what we call T-Day, the implementation of the new schemes. So what we were going to get is, we were going to take these weirdo tax deduction calculations for pension funds, which have failed thousands of students for years, and we were going to finally trash them. And then we were going to say, look, there's an inconsistency on retirement proceeds between provident funds and retirement annuity funds and pension funds. Provident funds, you can take a 100% lump sum. And what Prof and Gordon seemed to be very keen on was forced preservation. We don't want you to take your provident fund, pay a chunk of tax, and lend it to your son so he can start a coffee shop in George with his friends, because we know it's all going to get spent. So we would like to make provident funds aligned with retirement annuity funds. The only problem with that was the unions hated it. They said, no, when you retire or resign, you must take that 100% and pay the tax and then pay back your loan shark. So as a result of that, in October last year, suddenly overnight, T-Day gets delayed by National Treasury says a year, and the unions say 2 years. Now, Patrick Craven, I think it was, said this is a massive victory for the unions. I can't understand that, because when one comes to the proposals, when it comes to the tax side of it, the new proposal said we'll cap pension fund contributions all in at 350,000 or 27.5% of taxable income. So somebody who's making 100 million rand this year can put 15% into an RA and reduce their average tax rate by 6%. That continues until at least a year from now. And capping will only come in, they hope, on the 1st of March 2016. Now, I think that regime will happen. The union's big issue was on preservation, not on the tax issues of this. So there's a 1-year delay. Well, of course, everybody got hugely excited last year when we got new lump sum tables. There was one for early withdrawal, and there was one for that date that you retire. And, people start saying, I'm going to, take a 3 million rand lump sum. That table should simply read, for every South African, I will take up to 700,000 rand on the day I retire, and that's it. Why would you take a lump sum of more than 700,000 rand, potentially pay 36% tax, to take the income out of the fund, then you invest it and pay tax on the income that you've earned, then your family steals it from you, okay, and to top it all, whatever's left goes into a state duty computation. Just because we've always taken lump sums since, mom and dad did it years ago, doesn't mean that we need to do it today. I'm saying that table is good to 700,000, then stop. But now National Treasury want to become financial advisors. So they are now pushing, and they're going to be on a roadshow, I believe, next week, where they're going to launch the tax-free investment. We're going to go back to the days that grannies loved of a tax-free savings account. And those, I'm sorry, those things have destroyed more South Africans than you can imagine. So we're going to have an exemption from dividend tax, very valuable for the lower income person. You don't pay that 15%. No capital gains tax, no tax on income. Sounds wonderful, doesn't it? And we are going to allow you to contribute 30,000 a year. They haven't put that level up since they first proposed this 5 years ago, and a maximum contributions of 500,000 in a lifetime, so it grows up from there. The problem that they've got with that is that if while it's growing you withdraw some because everybody has a divorce once in a while, you can't put that money back in. You start again from scratch. So the contribution levels have a problem with that. and there's a stiff penalty if you exceed the contribution levels. But let's put some numbers to it. So we've got a taxpayer here who buys one of these products. It can have an equity component. He's got a 40% tax rate. He contributes 2,500 rands per month, 30,000 rand a year, for 20 years. And on this scenario here, after tax on all the income, if it wasn't a tax-free interest, just a straight unit trust, 745,000 rand after 20 years. And we say, okay, might help. Now, if you now change the assumption to it's a tax-free investment, same scenario, 1.2 million. So if you look at that, you say, these things are cool. Okay, I must go and tell my mother about them. And she'll put in tax-free investment, I'll inherit it. But what you should be saying is, Mom, no. Because that tax-free investment still doesn't give me two things. It doesn't give me an estate duty cover, because that will fall in my estate. And it doesn't give me a tax deduction on contribution. If I made the same contributions to an RA investment, I'd be worth 1.2 million. So when one looks at this, we say the tax-free investment doesn't do it, except for if you have to have a retirement annuity, you have to stay locked in the fund until you're 55. Okay? For me, that's not too far away. I can wait. If you're 25 and you're saving for your next divorce, don't use a retirement annuity, okay? Because you won't be able to access it. Rather use one of these tax-free funds for divorces, kids, education, that type of thing. New product to be rolled out next week. But then comes the question of tax rates and pensions. And we see the reduction in the average tax rate of South Africa from 34% down to 18% today. And people say, well, that's a pretty picture, that's just fine. And I say, well, actually not. Because there's something in that we can actually use. We say, there is that tax table. When I'm old and grey and tired and sick and stupid, I'm going to live at the bottom end of the tail. I'm going to get the fiscal drag adjustment without the tax increase. Because when I retire, this should be a board exam question, the components of my taxable income will be capital gains, 13%, not too bad, insurance policies and tax-free investments exempt, and then I'm going to get gross income from my retirement annuity fund. But something magic happens to me when I turn 65. I change as a taxpayer. I get bigger annual allowances, I get a bigger medical rebate, I get a geriatric rebate, and you've got to put all of those things together. And using the living annuity principle, say, the fact that I receive taxable income doesn't hurt. Hit me with it. Because whatever comes out and is paid to Discovery Health on my medical rebate will be absorbed by the medical rebate, no tax problem there. And then I can take some income into the lower end of the tax table where I am with the group of low income earners in South Africa. And we can do some amazing things when we do the budgets on this, where we say, instead of talking to a financial advisor when you retire and drawing a lump sum and being condemned to a life annuity, you must condemn yourself to a living annuity. You see them every year, and you say, I want to so much from interest, so much from capital gains, so much from annuity income, and then I'll buy another one. Because currently you can continue contributing to a retirement annuity until you die. The 70-year-old rule is gone. And then I'm going to have primary rebates, geriatric rebates, and medical rebates. And you can see on that scenario there that my average tax rate in retirement on 500,000 rand is not 25, 26%, it's actually 8%. I don't have a tax problem in retirement. So using that, we are saying there's a different way of doing this whole thing. We look at staying in the fund. And there's a final reason to stay in the fund. And this really freaks your kids out. Because when you die, the proceeds from your retirement funds are estate duty free. And the reason for that is we have to treat all benefits the same, cash or annuity. Now, every parliamentarian, judge, etc., has a pension. A week before they die, they generally marry somebody much younger so that they can inherit the pension. tax-free. That's why all judges have these young ones. And what we do with it is that we say, okay, be the same as the judge. Have everything in the retirement annuity. It's treated the same as the pension fund. And there is a lot of stuff that we can do in saving tax on this basis. Okay? And the retirement annuity fund has become the tax planning thing of the future. However, I say that subject to the caveats that the scheme of bullet premiums paid to a retirement annuity fund, non-tax deductible the day before you die, put everything in an RSA'S washing machine, that's going to be stopped. And they are looking at a mandatory retirement age for retirement funds. Again, that's still being considered. The Davis Tax Committee report on estate duty, we've done it now. It will be released very shortly. It's with the Minister. That, remarkably resilient. Why didn't it go up? Because if we don't want a fight with the unions, they'll have to save that for when NHI comes in. Notice a tiny number of vendors with income of more than 30 million rand a year pay 80% of the VAT payments to ZARS. They're going to get audited. The VAT system is going to sit there. The first Davis tax report is out on the VAT system. Every economist in the world is saying it's too low, it should be 17.5%, we should take away all the zero ratings because that's what's helping the poor. And in South Africa, you've got to realize that once you've given something away, you can never take it back. Moving the VAT rate still becomes the major challenge. Then the blow that we took today is on the fuel levy. So last year, we go up by 12 cents a litre, 8 cents on road accident fund. Total, fourth biggest tax, 47 million rand a year. And the tax take on fuel is 22% of the price of the retail price of fuel. This afternoon, we go fuel 413, diesel 398. Now watch this, you're going to freak out. 30 cents will go into the General Revenue Fund. 50 cents a litre to the road accident fund. Man, I'm going to be an ambulance chaser lawyer from tomorrow. They're going to refund that thing, and boy, oh boy, I'm going to fall off my bike very soon. Okay? So we get a massive amount of it going there. In fact, if you look at the increase in the tax collections, they're not that great. Only takes it up to 49 billion. What's sad about this is that we looked at it and we thought, well, you know, this is an opportunity, but the road accident fund took it. But not too quickly. Everybody was predicting the increase in the oil, in the petrol price, because the price of oil has halved in 6 months. So a month ago, people started talking about this. The price of a barrel of oil, even with a lower exchange rate, has dropped from 1,200 rand a barrel to low point about 575. That's magnificent. And the petrol price has come down 4 rand a litre. We're down at 10. And nobody could ever have predicted that a year ago. And we look at this as the savior in difficult times. Maybe not. Because since January, it's coming back. And there we have it coming back from below 50 into the 60s. And then we couple that with a weaker exchange rate. And we see that we've already given back 150 rand a barrel of what we made. So here's a little calculation. We're in February, 10 rand a litre. Because of the movement from 48 to 60, we'll be at 10.70 by next week. Add 80 cents, and we'll be at 8.50 by 11.50 by April, with no increase in the fuel price and no decrease in the exchange rate. We're going to be back at 12 before you know it. Carbon taxes, well, everybody seems to be running away from that. We're still talking about it. No implementation date yet. The Davis Tax Committee is to look at that this year. And so you say, right, we're getting towards the end of this presentation now, time to drink. R1.24 per beer you see tonight. DOP went up 4 rand a bottle. And that's $1 billion of the 15 that we needed. And we're going to try and stiff another 600 million on the smokers, but most of them have gone to dope and contraband from Zim anyway. So it's doubtful whether they'll ever get that sort of money in there anyway. Transfer duty surprised everybody today, because all the estate agents are already celebrating. There's a transfer duty reduction, buy a new house. What they don't read, down the right-hand corner, they may have increased the basic threshold from 600,000 to 750,000, but go over 2.2 million, and we suddenly got 11%, up 3%. That makes it a lot more expensive to buy a Constantia. And what's interesting in that is that if one reads the European Union report on wealth taxes, they say transfer duty is a wealth tax. It's certainly not an income tax. It's not a value add tax. There was a house then, somebody's already paid tax on it. There's no more value second hand. So by default, it must be a wealth tax. And suddenly we've crept that in. In the numbers, they're balancing off to within 100 million, what we're giving away at the lower end to what we're putting on the top at the higher end. Quite interesting. So it's time to conclude. And this is the stuff that's bugging Gilbert Grape tonight. Last year I got to 53, which is the average life expectancy of a South African. And that's where you get worried. So you go on websites and you start doing things like looking at what's my life expectancy. And if you go on the World Health Organization website, they say no. 53 is for all South Africans. Rich, poor, workers, non-workers, etc. But if you live to the age of 60, your life expectancy is 78. There's a huge difference between the life expectancy of rich and poor in South Africa. Massive. So this got me worried, and I thought, well, let's put this thing in an app I found on the thing. What am I going to look like in the future? And it came back by 2020. Tried 2013, it was Keith Richards. So Jess looked at this as my daughter. She says, that looks good. Here's your ring for Christmas, Dad. And it's wonderful because you can go like this and show your ring to everybody. Anyway, 1976, 16th of June, I was at St. John's College, somewhere in that building. In the chapel that morning, we were sang for those who petrol on the sea, I think. And by that afternoon, we had that picture. And it has haunted me since I was at the age of 12. The same age as Hector Peterson would have been. And always worried, what would happen? And then we see the evolution of that, as the Perio puts it, that we got to the end of one struggle and started another one. And that struggle, we're making some progress on. And then another struggle started. And now we get to next year, it will be 40 years since that fateful day. And we see that something's changed in the population. The death rate got to its height in 2005, thanks to Thabo Mbeki. 710,000 people a year, and half of them were from AIDS. We have to give credit, though, that in the Zuma administration, the birth rate has gone up minusculely. But the total number of deaths has declined, and the AIDS death rate has halved due to the high amount of antiretrovirals. But we are adding 656,000 South Africans to the population every year. Now take that. In the National Development Plan, Trevor Manuel's great cake, he made the estimate that by 2030 there would be 58 million South Africans. Stats SA last year published 64 million because that in 2011 we thought that the death rate would continue. So in our key document that drives South Africa, there will be 6 million more people than the NDP says. And people say, oh, the grants, imagine the strain on the grants. And it's amazing that the predictions of National Treasury and the World Bank, who modeled this thing in great detail last year, show that the effect or the stress created by the grants on the system is reduced. And certainly if you look at the increases in the grants today, they were tiny. So you would think, well, we can afford it, another 6 million. But there isn't. If one goes further into the World Bank studies of last year, we see that South Africa's Gini coefficient, if one takes into account the grant system, South Africa's Gini coefficient has dropped to 59. It is the fastest dropping Gini coefficient in the world. Agreeably, we started off on an awful base of about 70, and we have to take the grants into account in determining the Gini coefficient. But what's happening in the population is that we get what we call the bulging middle. People who do not receive grants, where the population is growing, and we can't provide these jobs. And the promises that we've made, we can't afford. So we've told them NHI at some time between now and 2020. That's a Thabo Mbeki promise from 2007, which went all the way to the Northern Transvaal, and they said we're going to do it. But if you look at the expenditure profile of South Africa, we can't afford it. And then if we take all the other government policies, we see in grey a static revenue trend, and in red the trend if they bring in the policies that they want with NHI, sectoral training, and all the upliftments for the missing middle. This budget today checked the rot on the debt on the existing game plan. No increase in benefits. But that's not going to get us to 2030. If you go back to the National Treasury working papers of November 2014, they said we are going to be under huge pressure in years to come as we look for the expansion of NHI, vocational training, and growth in public works. And the money can only come from growth, where? Increased taxation, we saw it today, or shifting resources to other priorities. That is straight, word for word, out of the National Treasury papers following the World Bank report. Excuse me. So today, we are looking at, we've contained the debt. We've done nothing towards achieving the objectives of 2030. And when one looks at the fundamental problem, maybe this is not tax. I love these words of Tolkien. From the ashes of fire shall be woken, a light from the shadows shall spring, etc. We've seen that happen in South Africa. That's what made us the Rainbow Nation. Renewed is the blade that was broken, the crownless will again be king. And we've seen two South Africans do that. The biggest comeback since Lazarus, both of them, come from obscurity to major leaders. And when I look at 2030, I say, who's going to lead us? Because we can have economic policy and the Davis Tax Committee and everything else. But who's going to provide that magnificent leadership that made it work for South Africa in the early days of democracy, and we're so missing it now? Thank you very much.